All right, let's dive right into this explainer and unpack the absolutely incredible numbers behind Goldman Sachs's blockbuster second quarter of 2026. If you've been following the financial markets lately, you know that setting records in today's complex macroeconomic environment is definitely no small feat. We're dealing with wildly fluctuating interest rates, shifting geopolitical tensions, and a totally unpredictable consumer base. And yet, despite all those headwinds, this quarter was just an absolute masterclass in legacy banking. So today, we're going to tear down the architecture of this earnings report to see exactly how they pulled it off and, more importantly, what it signals for the rest of the year. We're starting off with an absolute monster of a top-line figure, $20.34 billion. That is the net revenue Goldman Sachs generated in just a single 3-month period. To put that into perspective, we're talking about a massive 39% jump from the second quarter of last year. The big takeaway here is that this isn't just some incremental, slow and steady growth. It's a massive acceleration in their core business. For a mature legacy financial institution of this size to suddenly post a near 40% jump in quarterly revenue, that's incredibly rare. It basically signals that something fundamental is working exceptionally well across their core trading desks. And here's the best part. That massive top-line revenue trickles down perfectly to the metric investors actually care about most, diluted earnings per share. That $20 billion revenue translated into $20.98 per share for the quarter. Compare that to the $10.91 from Q2 of 2025, and you can see how this performance is just completely redefining what a successful quarter looks like for them. They literally doubled their earnings power year over year. It proves that their revenue growth wasn't just empty volume, it was highly profitable business that went straight to the bottom line. So to make sense of this massive financial engine, we're going to quickly walk through a few key areas today: the record-breaking quarter, the flywheel effect, global banking and markets, asset and wealth management, platform solutions, and finally, the shareholder payoff. Let's get right into it. Section 1. A record-breaking quarter. By the numbers. Let's peel back the layers of this financial report card as a whole before we get into the nitty-gritty of the individual business segments. Look at the sheer scale of the year-over-year growth across the board here. It's just incredible. Net revenues jumped 39%, resulting in a 23.5% annualized return on equity. Now, in simple terms, for every single dollar of equity the firm holds, they are generating an impressive 23.5 cents in pure profit. That proves some truly incredible capital efficiency. It tells us that not only is Goldman Sachs bringing in way more money, but management is deploying their capital brilliantly. They aren't just getting bigger, they're actually getting leaner and sharper. Moving on to Section 2, the flywheel effect. Momentum breeding momentum. To really understand these numbers, we have to look at the connective tissue driving the entire firm forward. CEO David Solomon actually hit the nail on the head during the earnings release when he framed this with the concept of a flywheel. He noted that clients are turning to Goldman to lead their most strategic, highly consequential transactions. And these big moves, they're often the genesis of activity across the entire franchise. Think of it like a giant wheel. Once a massive corporate merger gets it spinning in one division, that momentum just effortlessly transfers over to their financing desks, then trickles down into their wealth management arms, and so on. It's a self-feeding ecosystem where momentum organically breeds even more momentum. Section 3, Global Banking and Markets, the powerhouse engine. Now it's time to figure out exactly which cylinder in this massive financial engine was running the hottest. Remember that total $20 billion pie we discussed earlier? Well, an astounding $15.52 billion of that came from just this one segment. Global banking and markets completely dominated the firm's revenue stream this quarter, making up roughly 3/4 of the entire business. It is the absolute powerhouse of the firm right now. When you see numbers this disproportionate, it means their institutional clients are incredibly active, constantly tapping Goldman to navigate global capital markets, secure funding, and execute massive, complex trades. And inside that powerhouse, performance was fueled by explosive, across-the-board surges. Get this. Equities revenues rocketed up an incredible 72%. Investment banking fees jumped 55%. And FICC, which is fixed income, currency, and commodities, was up 32%. Literally every single major desk in this division was seeing massive double-digit expansion. The fact that FICC grew by a third means they capitalize aggressively on global interest rate movements and commodity price volatility. They basically turned macro shifts into pure profit. Digging into the raw breakdown, you can see exactly how they crushed it. Equities saw record intermediation in financing, particularly in complex derivatives and prime financing for hedge funds. Meanwhile, investment banking benefited from a huge surge in debt and equity underwriting, alongside significantly higher advisory revenues from a sudden rush of completed mergers and acquisitions. Remember that flywheel David Solomon mentioned? Yeah, this is exactly what it looks like in action. The advisory team closes a merger, and boom, suddenly the underwriting team is issuing the debt to fund it. Section 4, Asset and Wealth Management, the steady giant. If global banking provided the explosive growth, this next segment is the rock-solid, steady foundation for the firm. Just a quick refresher before we hit the numbers, let's make sure we're on the same page about AUS, or Assets Under Supervision. Simply put, this is the giant pool of money that individuals, massive institutions, and sovereign funds trust Goldman Sachs to manage and protect on their behalf. It's the ultimate barometer of trust in the wealth management game, and it creates a highly predictable stream of management fees, regardless of whether the broader stock market is up or down on any given day. And wow, that pool of trusted capital has now swollen to a record-breaking $4.04 trillion. Yes, trillion with a T. This is a monumental milestone for the firm, representing an almost unimaginable amount of global wealth concentrated under one roof. Crossing the $4 trillion mark drives a massive chunk of their steady, recurring management fees, which, by the way, also comfortably hit an all-time record this quarter. It's an incredibly sticky business model that anchors the firm's overall revenues. So how'd they actually cross the $4 trillion mark? It was kind of a 1-2 punch during the quarter. First, they brought in $91 billion in long-term net inflows from clients. Let that sink in for a second. That represents their 34th consecutive quarter of long-term fee-based net inflows. That is literally years of consistent trust being rewarded. Combine that new money with a massive $161 billion organic boost just from the broader markets appreciating, and you get a truly historic quarter for the wealth management division. Section 5, Platform Solutions, the Strategic Retreat. Now, let's see how a very deliberate pullback impacted the bottom line. Unlike the other divisions that were completely firing on all cylinders, this segment was intentionally cooled down. It's really a story of strategic refocusing. A major driver of this division's historical activity used to be massive consumer-facing partnerships, but late last year, Goldman transferred the massive Apple Card loan portfolio to a held-for-sale status. They made a conscious, incredibly bold choice to trim away these non-core consumer operations so they could refocus their capital entirely on their institutional and wealth management flywheels. Because of the resulting net markdowns from moving that Apple Card portfolio, net revenues in Platform Solutions plummeted 64% year over year to just $221 million. Now, I know what you're thinking. A drop like that is normally a massive red flag, right? But in this specific context, it actually reflects a super disciplined strategic shift. The firm took the short-term hit to clean up its balance sheet, remove volatile consumer credit risk, and pivot its energy back toward what it arguably does best, serving ultra-high net worth clients and global institutions. Section 6, the shareholder payoff, reaping the rewards. All of these moving parts, the explosive growth in markets, the steady trillion-dollar giants in wealth, and the strategic retreats in consumer platforms, ultimately lead us to one question. What is the payoff for the investor? Well, the firm definitely leveraged this massive quarter to reward shareholders directly. The board of directors announced they're increasing the quarterly dividend by 11%, bringing it to a flat $5 per common share. When a firm bumps its dividend by double digits like this, that is generally the strongest possible signal of management's confidence in their ongoing long-term cash flow. It shows they truly believe in the sustainability of that flywheel effect we talked about. But hey, the dividend is just one piece of the puzzle here. In total, they funneled $5.36 billion back to shareholders in just 3 months. And the vast majority of that, a whopping $4 billion, was executed through a massive share buyback program. They basically went into the open market and retired over 4 million shares. This strategy directly concentrates the equity, making every remaining share that you hold that much more valuable. So that brings us to the end of our explainer today, and it leaves us with one really provocative thought. With record-breaking revenues in the rearview mirror, over $4 trillion in assets under supervision, and billions deliberately returned to shareholders, the ultimate question is whether Goldman's massive flywheel has enough momentum to defy macroeconomic gravity for the rest of the year. Will the back half of 2026 see this wheel spin even faster, or will tightening market realities begin to create some friction? That is exactly what we're going to be watching for next. Thanks so much for joining me, and I'll catch you next time.